74.19 million ounces, that's how much gold China officially holds as of January 2026. But here's what should terrify you. That number just increased for the 15th consecutive month, 15 months in a row. Not once did they pause, not once did they hesitate. And if you're holding dollars right now, if you think your savings account is safe, if you believe the financial system you grew up trusting is still the same system, you need to stop everything and listen to what I'm about to tell you, because by the end of this video, you'll understand exactly why the world's second largest economy is quietly preparing for something massive, and why gold just became the most important asset class on planet Earth. Welcome to Financial Truth Uncensored. I'm here to show you what's really happening in markets, while mainstream media feeds you recycled headlines and comfortable lies. If you're new here, I break down complex financial events into actionable intelligence that can actually protect your wealth. Subscribe right now, because this channel doesn't play by the rules of financial entertainment. We deal in documented facts that the establishment doesn't want you connecting together. And if this video opens your eyes to what's really happening, smash that like button so more people can see this before it's too late. Let me tell you something that doesn't make sense. Gold hit $5,100 per ounce in January 2026. That's a 62% increase in just 12 months. 62%. Meanwhile, China's central bank kept buying and buying and buying. Through every price increase, through every record high, through levels that should have made any rational buyer pause, they kept accumulating. Now here's where it gets weird. Chinese gold ETFs doubled their holdings. Retail investors in Shanghai were queuing for hours. Not minutes, hours, just to buy physical gold at the highest prices in recorded history. This violates every principle of basic economics. When prices surge, demand should fall. When assets hit all-time highs, smart money should be selling. But China, they're accelerating. Something is very wrong. And by the end of this video, you will understand exactly what it is. Let me show you the numbers that nobody is talking about. The People's Bank of China added 27 tons per month throughout 2025. Every single month. 27 tons. That's not opportunistic buying during dips. That's systematic accumulation with a deadline. Their official reserves now stand at 2,308 tons, representing 9.6% of their total foreign exchange reserves, valued at $369.58 billion. But wait, it gets worse. Market analysts believe the real number is significantly higher because China has a documented history of underreporting their strategic gold positions. They did it before the 2015 announcement. They're likely doing it now. Now look at this. Chinese gold ETFs saw their strongest year on record. Assets under management surged 243% to 242 billion yuan. That's 35 billion US dollars flooding into gold-backed securities in a single year. Physical holdings doubled to 248 tons. Retail investors poured in 112 billion yuan despite watching prices hit record after record after record. This is not normal behavior. This is not wealth preservation. This is preparation. But wait, it gets worse. Shanghai Gold Exchange withdrawals totaled 1,298 tons in 2025. Even though this represented an 11% decrease from the previous year, it still shows massive underlying demand at prices that should have crushed consumer interest. Think about that. Gold increased 62%, and Chinese citizens still withdrew almost 1,300 tons of physical metal. That's not speculation, that's conviction. I have the data right here. In January 2026, Chinese gold ETFs added 38 tons in a single month. 38 tons. That's the strongest start to any year on record. Total holdings reached 286 tons, an all-time high. The Shanghai Futures Exchange traded 456 tons per day during January. 456 tons daily. That's 17% higher than December and 72% above the 5-year average. These are not made-up numbers. Anyone can verify this through the World Gold Council, through the People's Bank of China official data, through the Shanghai Gold Exchange public records. This is documented fact. Now let me show you something fascinating. Hong Kong precious metals dealers reported unprecedented supply constraints throughout late 2025 and early January 2026. Simon Littman, executive manager of Swiss Investors Corporation Limited, stated that January 2026 was his best business month in approximately 20 years in the precious metals trade. 20 years. The man has been in this business for 2 decades, and he's never seen demand like this. Small gold bars became increasingly difficult to source. Refineries worldwide rushed to boost production capacity. The supply chains that have handled global gold distribution for generations couldn't keep up with Chinese demand. Here's what this means for you. When a nation systematically accumulates an asset for 15 consecutive months, through record-breaking price increases. When retail investors wait in multi-hour queues to buy at all-time highs, when supply chains crack under demand pressure, they know something you don't. They're seeing something that hasn't been publicly announced yet. They're preparing for a change in the global financial system that makes current gold prices look cheap. While you were checking your retirement account balance and feeling good about 7% annual returns, China was repositioning itself for a post-dollar world. While you were reading headlines about inflation being transitory and the Fed having everything under control, Chinese central planners were converting dollar-denominated reserves into hard assets that can't be printed, can't be sanctioned, and can't be devalued by a foreign government. While you were sleeping, they were building a parallel financial system. This is not conspiracy. This is documented fact. Let me show you the mechanism of wealth transfer that's happening right now. Every month, China buys 27 tons of gold. They're simultaneously reducing their exposure to U.S. Treasury holdings. In November 2025, China's U.S. Treasury holdings dropped to $682 billion, down 11% year over year, 11% reduction. They're systematically exiting dollar-denominated assets and entering gold. Every ton they buy makes their currency more stable while making the dollar relatively weaker. Every ton removes supply from a market that's already stretched thin. Every ton increases their monetary independence while increasing American vulnerability to their own debt monetization. The wealth transfer is mathematical. As China and approximately 60 other central banks combine to purchase 87 tons per month, they're removing over 1,000 tons annually from available supply. Global gold mine production adds approximately 3,000 tons per year. That means central banks alone are absorbing nearly 1/3 of new supply before it reaches jewelry markets, before it reaches industrial applications, before retail investors in the West even know it exists. They're cornering a market in slow motion, and by the time mainstream financial media reports it, the opportunity will be gone. This is why professionals are positioning now while retail investors are still debating whether gold is a good investment. The smart money understands that when central banks compete for physical assets, price becomes secondary to acquisition. They have unlimited currency to spend. They have strategic time frames measured in decades, not quarters. They have access to information that won't reach public consciousness until the move is complete. Now let me explain how this actually works, because understanding the mechanism is crucial. Think of it like musical chairs. The global financial system has a certain amount of gold, a certain amount of confidence in fiat currencies, and a finite supply of both. Every month that China converts dollars to gold, there's one less chair available when the music stops. Every ton removed from available supply means the remaining supply becomes more valuable. Every dollar they sell means one more dollar that needs a buyer to maintain value. Here's the critical insight, and I'm going to repeat this 3 times in different ways because you need to understand it. Gold is not increasing in value. The dollar is decreasing in purchasing power, and gold is simply maintaining its real value while fiat currencies deteriorate. Said another way, you don't buy gold to get rich, you buy gold to stay rich while everything around you loses value. One more time with the mechanism fully exposed. Every dollar the Federal Reserve prints dilutes your purchasing power, while every ounce of gold maintains its proportion of global wealth because they can't print more of it. This is why professionals understand gold as insurance rather than investment. The premium you pay today protects against the systematic devaluation that's mathematically guaranteed when a government runs $34 trillion in debt with no plan to pay it back. China understands this. Russia understands this. India, Turkey, and dozens of other nations understand this. The question is, do you? I've seen this exact pattern before. In the lead up to 2008, certain institutions were quietly exiting mortgage-backed securities while publicly maintaining confidence. In 2020, billionaires were selling equities in February while mainstream analysts called for all-time highs. In both cases, the public data was available, but retail investors didn't connect the dots until the crisis was already unfolding. The pattern repeats because human nature is predictable. We trust authority figures, we assume the system is stable, and we ignore evidence that contradicts our comfortable assumptions. China's current gold accumulation mirrors the strategic positioning we saw from central banks in 2008 to 2010, when sovereign debt concerns drove systematic accumulation. Between 2008 and 2010, gold increased from $700 to $1,400 per ounce. The question is, will history repeat? Based on current accumulation rates, supply constraints, and dollar debasement trajectories, I believe we're in the early stages of a move that makes 2008 to 2010 look minor. Here's my specific prediction, on the record. Gold will reach $6,000 per ounce before December 31st, 2026. That's a screenshot-worthy claim. By the fourth quarter of 2026, we'll see gold trading between $5,400 and $6,400 per ounce, driven primarily by continued Chinese demand, central bank accumulation exceeding 800 tons annually, and escalating concerns about U.S. debt sustainability. The catalyst will be a Treasury auction that fails to meet full demand, forcing the Federal Reserve to absorb more government debt directly, confirming to markets that the dollar's backing is nothing but more dollars. Screenshot this, hold me accountable. If I'm wrong, call me out in the comments section of that future video. But if I'm right, you'll understand why positioning now matters. Now let me tell you what this means for you. There are 3 types of people watching this video right now. Type 1. You're going to ignore this information, keep your money in dollars and traditional equities, and convince yourself that the system you've always known will continue working the way it always has. You will regret this when the purchasing power of your savings erodes faster than your asset returns can compensate. You'll look back at this moment and realize you had the information but chose comfortable denial over uncomfortable action. Type 2. You're confused and uncertain. You understand something significant is happening, but don't know what specific actions to take. You're worried about timing the market, about buying at the top, about making a mistake. You will miss out on the optimal positioning window because analysis paralysis prevents decisive action. By the time your concerns are fully addressed by overwhelming evidence, the easy profits will belong to people who acted 6 months earlier. Type 3. You recognize the pattern, you understand the mechanism, and you're ready to position accordingly. You will benefit by preserving purchasing power, while others watch their dollar-denominated wealth lose real value. You'll hold assets that central banks compete to acquire instead of assets that central banks can print unlimited quantities of. Which type are you? If I were in your position right now, here's exactly what I would do. First, understand your current dollar exposure. Add up your checking account, savings account, money market funds, and any cash sitting idle. That's your vulnerability. That's the amount currently losing purchasing power to systematic debasement. Second, determine what percentage represents funds you don't need for immediate expenses. That's your repositioning capacity. Third, consider allocating a portion of that capacity to physical gold through reputable dealers with transparent pricing above spot prices. I'm not telling you to mortgage your house and buy gold. I'm suggesting you examine whether 10%, 15%, or 20% of your liquid assets should be in something that can't be printed. Fourth, if direct physical ownership seems complicated, investigate gold-backed ETFs that hold actual bullion rather than paper derivatives. Verify the custodial arrangements. Verify the audit frequency. Verify the ability to redeem for physical metal if needed. Fifth, understand that this is not a trade with a target price where you sell. This is a reallocation of wealth preservation assets. You're not buying gold to sell it at $6,000. You're buying gold to maintain purchasing power while fiat currency loses value over the next decade. Sixth, ignore short-term price volatility. Gold dropped from $5,100 to $4,400 in a single day during early February 2026. If you panic during those moves, you're not psychologically suited for this allocation. The purpose is long-term wealth preservation, not short-term speculation. Seventh, educate yourself continuously. Understand the relationship between real interest rates, currency debasement, and gold performance. The more you understand the mechanism, the less emotional your decisions become. I know what some of you are thinking right now. You're thinking, this sounds extreme. This sounds like doomsday prepping. The system has worked my entire life. Why would it fail now? Let me validate that emotion. It's reasonable to feel uncomfortable when information contradicts your lifetime of experience. It's natural to resist ideas that require changing your financial worldview. It's human to hope that problems will resolve themselves without requiring action on your part. But here's what hasn't changed: mathematics. The United States has $34 trillion in debt. Annual deficits exceed $1 trillion. Interest payments on existing debt now consume 22% of federal revenue. These numbers don't care about your comfort level. These numbers don't respond to optimism. These numbers continue compounding whether you acknowledge them or not. China is preparing for what mathematics makes inevitable. The question is whether you'll prepare or pretend. Remember what I said at the beginning of this video? 74.19 million ounces, 15 consecutive months of purchases, systematic accumulation through record prices. Now you understand why. This is why China isn't stopping. This is why they're accelerating even as prices surge. This is why their retail investors wait hours to buy at all-time highs. They're not buying gold. They're exiting a monetary system they believe is approaching fundamental instability. They're converting claims on future American productivity into assets with 5,000 years of monetary history. They're choosing tangible value over digital promises. Let me leave you with this. In 1971, President Nixon closed the gold window, ending dollar convertibility to gold at $35 per ounce. The world didn't end. The system adapted, but gold went from $35 to $850 over the next 9 years. Those who understood the significance of that August decision multiplied their purchasing power 24 times. Those who dismissed it as irrelevant maintained their dollar holdings and lost 75% of their real wealth to inflation through the 1970s. You're watching a similar inflection point right now. The difference is that this time, you have the information before the move is complete. If this video opened your eyes to what's actually happening in global markets right now, hit that like button so YouTube shows this to more people who need to see it. Drop the word gold in the comments if you're taking this seriously. Tell me your biggest concern about the current financial system. Are you worried about inflation, dollar devaluation, bank stability? I read every single comment, and your questions help me understand what topics to cover in future videos. Subscribe and turn on notifications because I'm making a follow-up video on February 28th covering the next phase of China's strategy and what it means for silver, which most people are completely ignoring. The next few years are going to separate those who prepared from those who hoped. I'll see you in the next one.